Es evidente que durante la pandemia se ha abierto una ventana de oportunidad a las nuevas inversiones y que se ha podido invertir en países como el nuestro a precios mucho más competitivos. Por lo tanto, España se consolida como un destino de inversión clave ahora mismo en el sector inmobiliario. El país será uno de los 5 puntos más destacados en volumen de capital invertido en Europa en 2022, con una inyección cercana a los 7.500 millones de euros, según las inversiones, según las previsiones relevantes de consultoras inmobiliarias. España dicen que es un país muy atractivo, nosotros lo sabemos, pero los inversores también tienen que ser plenamente conscientes para hacer frente a esta nueva etapa tras la pandemia. Así que hoy vamos a analizar eso, cómo ven los capitales, el sector inmobiliario español tras esta pandemia. Lo vamos a hacer en este panel moderado por Carmina Gañet, ella es directora general corporativa de la inmobiliaria Colonial. Actualmente Carmina es también miembro del Consejo de la Universidad Ramon Llull y de SADE alumni. Y Montse Rius, que ya nos acompañó el año pasado, que vuelve a repetir en esta segunda edición, es Managing Director de Finanzas y Desarrollo Corporativo en Hotel Investment Partners de HIP y tiene más de 15 años de experiencia en el sector. Con ellas dos van a estar también, pero a través online, en streaming, James Wilkinson, director general de BlackRock Investment, que nos acompañará, pues como verán, en una de las pantallas aquí detrás, y Paul Gibson, director de inversiones, estrategias inmobiliarias directas para EMEA y CBRE Global Investors. Yo quería añadir que además este panel que tenemos por delante está organizado por Uli Esade. Tenemos muchísimos temas a tratar, así que yo no les quiero robar más tiempo. Enseguida hablamos, así que estén muy pendientes de cómo van a ser esas nuevas inversiones en el futuro. Muchísimas gracias y todo vuestro.
Thank you, Ellie, and we would like to thank you, everybody, to the audience for signing up, for the ones that are here and for the ones that are there behind the scenes. So we are here with Carmina. We are taking care of this session that has been organized by ESADE Club Inmobiliario and also for ULI. And obviously, we would like to thank you to the speakers, to James and to Paul that are joining us today with this debate. We are very happy to have them here because when we were within the executive committees preparing this session, thinking about the matter that concerns today, which is what Ellie has already announced before about the attractive of the investment market and especially Spain, we thought it was very important to have the views of the investors. How are the investors thinking about Spain and the real estate market? And for that purpose, we need two different views according to different strategies that are followed in the market. One, which is the private market, the investing in shares in company, which is super good represented by James Wilkinson. I'm sure you all know them. He has a sound track record in the listed market. He works in BlackRock, and BlackRock is one of the largest asset management companies in the world with more than 9 trillion millions of assets under management. And another different strategy is more focused in the ones focused in the private market, in direct investment, which is today represented by Paul Gibson. Thanks, Paul, and thanks to Enrique Martinez Laguna that has helped us also to bring and convince Paul to participate in this debate. So we have homework today, and the homework is to explain to the audience how do they think and read the current market situation. And let's start with something very, very easy. Let's talk about assets, and let's talk about asset class. And the first question for Paul and for James would be about priorities. Which are your main priorities among the different asset class? And when you answer that questions, we would like, please, if you can explain us why are these priorities, on what trends are these priorities based. So, James, would you like to take it first, the question?
Sure, thank you. Well, thanks very much for having me today. I'm sorry I can't be with you physically, but nonetheless, this is the next best thing. I think the first thing that I would say, just in terms of asset classes, is really sort of by way of reminder that actually real estate is a very dynamic asset class, a very dynamic market. And I think people sometimes forget that. And it's worth just looking back over the last 20 years to how the market has changed, how the balance of the opportunity set has gone from being one dominated by the traditional real estate sectors, so office, retail, industrial, and old school industrial, to one where the retail sector has shrunk significantly, offices have grown, industrial has grown into a very sophisticated logistics sector, and then new sectors have emerged, ranging from healthcare, education, through data centers, towers, etc. So it's a very dynamic sector fundamentally, and within listed markets, I would say that's sort of dialed up even more, really. It's sort of turbocharged. So over the last 15 years or so, just take retail, for example, that's roughly halved in terms of market capitalization. And, data centers were practically uninvestable within listed markets globally a decade or so ago, but now they're a very significant part of the landscape. So that's sort of by way of background, and I think a useful reminder. Our approach is fundamental. We believe that it's fundamental markets that really drive listed markets over the long term. But there's a caveat there, which is that share prices can oscillate around the actual fundamental valuations of the stock. So we can have some very strong fundamental views on sectors, but actually our portfolio positioning might deviate significantly from that because the share prices might have been blown out from those valuations. And in moments like now or over the last 18 months or so, that noise and that volatility can introduce even greater mispricing. So that's the caveat. But in terms of fundamental markets, I think we're broadly quite positive about real estate overall. I think one of the things that is interesting is that in core real estate markets, we have not seen oversupply really across the board. I mean, retail is an exception, and that's a structural issue rather than a development issue. But whether it's office markets or logistics markets or healthcare markets, there's a really sound balance of supply and demand. And so we're quite positive about the overall trajectory of things. We think that the macro backdrop is highly supportive. We think that the economic growth that we're seeing at the moment is going to continue to support rents and asset prices over the coming decades or so, really. And then the mega trends themselves are very positive as well. So broadly very positive. I think there are, if I was to pick out some particular sectors, then I would say we continue to be very positive about logistics. I think there are many years of supply in the way of demand now, 4 years of supply that we can see at least in terms of demand now. So that's going to continue to drive logistics markets. I think actually demand for the very best offices in the very best cities is actually really quite surprisingly strong, and that's quite positive. And then again, I think those sort of tech-driven sectors like data centers in particular are going to continue to see very strong demand and very strong cash flow growth for the next few years or so. So and that's just sort of picking out a couple of highlights.
May I ask you something, James, about this new asset class? Because as you said at the beginning, the industry is changing quite fast. And maybe even 5 years ago, we wouldn't be mentioning or referring to this new asset class that are now included in the list. So do you think that there's also investor appetite and institutional investor appetite for those new asset class?
Oh, very much so, very much so. I mean, investors are always looking to place themselves, at a better point on their sort of efficient frontier to get a better balance of risk and return. And so there's enormous capital looking to come into real assets broadly. I mean, that's the first thing to say. Demand for alternatives overall is huge. Demand for real assets within alternatives is huge, and then demand for real estate is huge as well. And for data centers, for towers, for healthcare, for education, for self-storage, for all of these diversifying sectors that offer really great risk-adjusted returns, investors really want to keep putting capital into those markets.
Excellent. Thank you for your views. So, Paul, let's go back to the question about the priorities to invest in the different asset class, and also if you could explain why these priorities are ranked in that way and what would be the trends that back these priorities.
Yeah, thanks, and hello everyone. I'm very glad you went for James first because he covered a lot of good ground there, and actually I would endorse a lot of what he said. But maybe thinking with my sort of private real estate lens on, I think I'd agree exactly with what James said. We feel pretty positive about real estate and the European markets, particularly when we look at the occupational side. So James talked about logistics. You know, if we look across the main markets in Europe, we're seeing really very low vacancy rates, below 5% in France, Germany, Benelux, UK. Really, I think about my sort of 20 years or so in real estate, I can't remember a time where we've had, you know, such low vacancy. And really, we when we're thinking about how we invest at the moment, we continue to believe in this structural growth story. So I think this year so far we've invested or deployed around 2.5 billion euros in the European direct markets, and about 80% of that has been in logistics or the residential space. But you know, that does leave a 20%, and I think where we see other opportunities really is around opportunities where we can have a social or an environmental benefit or impact. I think there's a lot of interesting opportunities in terms of revitalising or repositioning assets that maybe in their current form or with their current user base in mind can be readjusted to reinvigorate them. So that's a quick snapshot, and happy to delve into that in a bit more detail if you like.
Excellent, thanks. We are also probably curious to know, and also the audience, about the different markets and the different countries in Spain, given that you have global reach and global views, and you operate in so many countries. We would be interested in learning if you have also a specific preference for any country within Europe. And when I refer to Europe, I refer to Europe including UK, the physical, would say, part of Europe, not the political European Union.
Yeah, maybe I'll give James a chance. I'll go first on this one, sorry, James. But I think, well, firstly, we have been investing in Spain. We think there's, we talk about the macro. The European Recovery Fund is a good macro backdrop to have for Spain. I think in terms of talking about markets, I think it can get very general very quickly if we say which countries we like and which countries we don't like. But we're really focused actually on the assets themselves, and I think it's never been more important than to get close to the occupier, understand their needs. I think occupiers are becoming much more discerning, and their sort of thresholds for interest are raising all the time. And we're very focused on buildings that can help them improve their operations, be that helping them attract or retain labour, accommodate technology, or reduce carbon footprint. And so when we think about where we want to invest, we kind of have those things in mind. So, for example, we bought an office in Barcelona earlier this year. It's under development at the moment, and it sort of fulfills all of those criteria. Really, it's going to be a very green building, LED gold. It's very well connected. It's in 22 at. It's called Z Green Oasis, and really we think that the proposition that we'll offer to the customers of the building is going to be very compelling. So if the building characteristics puts the customer first, we're very open to investments across Europe, and Spain would certainly be in that category. And maybe give James one more minute to just think. But I think if we think about the sectors within Spain, we're very interested in the residential space. We think there are some good structural drivers there with the supply-demand imbalance, and that's a particular focus for us, speaking specifically about Spain.
James?
Thanks. Yeah, I mean, we're going to have to find some areas to disagree on, or this is going to be a boring panel. So, but actually, I agree with everything that Paul said. As I said in my opening, it's all about the fundamentals. And whilst we might not get or won't get as granular as Paul will get in terms of individual buildings and then the tenant roster and all the rest, it's certainly about those fundamental markets. So we absolutely focus on countries and on cities as well. And when we think about Spain, obviously this is a large country, large population, and there are very significant differences between cities and between regions. So, we really want to know a company that we're investing in, does it hold its assets in, Palma or Mallorca, or does it hold its assets in, Barcelona or Madrid? The outlook for those markets are going to be completely different. I think, one of the other things that we're thinking about, perhaps just to sort of look for specific things that might be a bit different. We're looking at regulation. So Paul mentioned residential. Regulation is very important when it comes to residential markets. And actually just in the last 24, 48 hours, we've seen some announcements in Spain that are going to or might well impact on residential markets. We've obviously seen what has been happening in Germany with regard to residential markets, and even at a local level in Berlin in terms of the efforts to force expropriation of portfolios. So regulation is hugely important, as well as the actual sort of physical assets. So yes, it is, as Paul alluded to, really, it's very difficult to say we like an entire country and we will therefore target capital at that country. It's really, look at the company, the assets it holds, the markets that it's exposed to, the risks it's exposed to in terms of regulation, financials, the management team, all of those things. And then for us, it's then look at the valuation of the company versus the share price, because again, as I said before, there can be quite a degree of difference between the fundamental valuation of the company and then the actual share price that we can buy it at. That short-term noise, although it's very uncomfortable, it can throw up some great opportunities.
Excellent. Well, with this answer, you kind of explain the preferences for countries, but more important, the preferences or the distinguish that you will make in your analysis depending on each location, because at the end of the day, real estate, it's quite local. It may be very different to invest in London or in Madrid, despite of the country that the cities are located. So just to wrap up this chapter on assets, could you please quick answer me priority number 1, priority number 2, and priority number 3 in terms of preference for asset class? Very quick. You can have 2 asset class in each priority if you want. So number 1, Paul, what would you buy tomorrow? What kind of asset could you buy tomorrow?
Okay, I'll give. There are two strategies that really come to mind for us at the moment. I mean, what we're seeing, I don't know if it's a trend that's been accelerated, but the social inequality has really risen to prominence, and in the residential space, we feel we can really help there. So we've got a couple of strategies that we're working on. One in the UK, we have an affordable housing fund, but we're kind of taking that across Europe, and we have a fund that's really looking to deliver good quality, affordable and sustainable homes. And I think that speaks a little bit to the regulation point that James discussed. We feel that I guess not immune, but is kind of less vulnerable to some of the regulation that's coming, and it's going to benefit society more broadly. So that would be a real focus for us, and we're certainly looking in Spain. The other area, if I could steal a second one, I talked about logistics, but we still see that, as I said, the occupier market's very strong. We're prepared to take some leasing risk there, so we're working closely with developers, really to capture, a bit of the development premium profit. We did it very successfully in Spain over the last few years with Montepino, which some of you may know about. Came in a way to sell that portfolio, but we see that as a strategy we want to continue with other developers and in Spain as well. So those would be two that would immediately spring to mind. James, over to you.
I'm going to have to try and think of something different now, aren't I? I might have said residential as well, to be honest. I mean, I think some of these scale residential players in markets like Germany, for example, are offer really fantastic prospective returns. But actually, in an effort to say something different, I might go for one or other of the tech sectors, either data centers or towers. I think that the growth from those sectors is going to be phenomenal. I also think in the towers sector, there are very significant consolidation benefits that will add to the bottom line cash flow growth in some of the listed companies. So I'll say broad sort of tech, perhaps let's call that digital and communications, real estate, number one. And then I'm going to have to say logistics. There's a reason why this sector is so popular, because demand and supply balance is phenomenal. But I might skew towards those players, those companies that can develop. I think rather surprisingly, the profits that you can make from logistics development have still not been sort of arbitraged away. Development returns are still really great, really attractive. And I say surprisingly because one might have thought that with such an enormous amount of capital coming through, that actually the development profits that people demand might have been whittled away from, 40 to 30 to 20 to 15. We've seen that in past cycles in other sectors, but that has not happened in logistics. So it's tech, digital communications, then it's logistics, but preferably a company that's got some good logistics development expertise as well.
Excellent. Thank you very much. I think that we all have a view on the appetite for the different asset class. During this conversation, James, you have already introduced some ideas on valuation. So I think it could be good to spend some time discussing about talking about returns and valuation. Carmina will take care of that matters. So
yes, well, in this section or in these conversations, we wanted also to cover the returns and the main challenges in the macroeconomic trends that are impacted in the expected returns. Everybody knows that we are experiencing a very competitive environment, low rates, huge liquidity in the system, unexpected consensus about GDP growth, especially in the countries which has been more impacted by the COVID, especially Spain, which it seems that the GDP growth for the next following 2 years would be more than 6%. With a lot of consensus about inflation and underlying positive inflation. So all this positive sentiment, all this positive economic sentiment, at the end creates a very competitive environment and potentially a more predictable cash flow. And we are wondering if you, James and Paul, are revisiting your expected returns. You are more cash flow driven or more growth driven when you approach any opportunity investment. So what do you expect for the investment, the future investment, for different asset class or different cities or different markets? Are you considering of taking additional risk, as James mentioned about the value-added strategies to get additional returns that with this competitive environment it's much more difficult to get? So we would like to understand how you are approaching your opportunities and what is the expected returns that you are potentially revisiting due to the fact this competitive environment. So Paul, if you want to start with your direct investment decisions.
Yeah, sure. This is going to be a bit of a woolly answer, but looking at the returns and whether we adjusted them, it depends. We obviously act for a variety of different types of investor, and we have a variety of different mandates. And I think it's fair to say all other things being equal, with yields having come down, being lower, prospective returns going forward look a little lower. Whether we've adjusted them does depend on the investor or the mandate. So, for example, we act for insurance companies. They're really looking at real estate as a premium to the government bond yields. So in that sense, we kind of adjust the returns accordingly. They're looking for very core assets, very stabilised income streams. and we all know where the pricing for those kind of assets is right now. For other mandates, we might be judged on a relative basis, so we may have to perform an index, and again, we will judge our return hurdles against our expectations for that index. But for other our mandates, we do have specific return hurdles to hit, and again, it's, as you said, it's about thinking about the risk return appetite. Some we will bring down, but on other occasions we do feel that we can take risk in certain areas. We talked a little earlier, James and I mentioned, in logistics with the strong occupational markets, maybe some development leasing risk there. So it's about being very selective and disciplined about where we take that risk. So it's a bit of a blended answer. I think it's fair to say sometimes we are reducing our return hurdles, on other occasions it doesn't, just depending on the nature of the mandate.
And James, how you approach this listed investment due to the fact that there's a huge disconnection between private markets and capital markets, and the returns has been the same that we targeted in the past?
So I think the first thing to say is, it depends is probably my favourite answer to all of life's really difficult questions. It might annoy people to use it, but it does depend on all sorts of things, context and definition of terms, etc., etc. But maybe just 10 seconds on our sort of valuation process. So we build up a cost of equity for every single one of our companies, and that is specific to the economy that company is exposed to, its assets, its financial structure, its management team, its environmental, social, and governance risk factors, etc. So we have a specific cost of equity, a required rate of return, if you like, for every single company. We then have cash flow forecasts for every single company, and the valuation of that company is very, elegantly, simply the discounted cash flows. It's the net present value of the future cash flows. So that's how we do it. As bond yields rise, then of course your required rate of return increases. As risks rise, then your required rate of return also increases. But on the other side, as economic growth increases and as inflation increases, then your cash flows increase. And again, let's remember, real estate is pro-cyclical and it is pro-inflationary. Lots of people are worried about inflation at the moment, and they're worried about interest rates. But actually, you look at the data, it's abundantly clear that real estate actually does quite well in periods of high inflation, so long as we don't tip over into stagflation. And that's not my central case. That's not BlackRock's central case at the moment. We're wary of it. Of course we are. It's one of the many risks that we look at. But on the whole, we adjust the required rates of return according to the risk environment. Some of those are macro, some of those are idiosyncratic to the company. But on the other side of the coin, there are also these increases in expected returns. So higher inflation and higher growth do drive higher cash flows, all else equal. So, expected returns, just actually trying to address your expected returns specifically and trying to say something that won't get me in trouble with my compliance teams, because we're all a bit wary about saying too much. So perhaps let me just state some data and then make a personal comment. But if you look historically, what real estate has generated over the long term, it's sort of low to middle single digit per annum returns. I don't think that it would be unreasonable to expect that at a sort of fundamental level, and you can then enhance those returns by taking a bit more risk or by actually leveraging those returns. I think you're right to reference the fact that some listed companies are mispriced versus their private sector equivalents. That is because of all the noise and volatility that we've had. So I think the underlying returns of those companies will be similar to those that Paul will see in private markets. But there is a sort of a mispricing pickup that you can get if you're prepared to sort of stomach the potential noise and volatility that you'll get in listed markets. But there are some cheap. In my view, there are some cheap companies in listed markets that are being mispriced because of very specific equity market factors at the moment.
Thanks, James. Before potentially, while discussing about the opportunities of the listed companies because of these disconnection values, in order to understand what could be, and you pointed out the point about the spread between bond yields and market and real estate yields. So we have the widest ever spread because of the low rate, because of the low level of bond yields. This sector, in average terms, in long term, it was a sector of 250 bips spread. Today, in certain asset class, we are at 300, even 350. It means that in a long-term oriented strategy, potentially, and thanks to the inflation, which is more predictable and more certainty in terms of cash flow and in terms of growth, you are assuming a reduction of this spread in your targeting investments? I mean, if today we have a 300 basis points spread, wide as ever, you are targeting a wider one due to the fact that we have certainty cash flows coming from inflation? James?
So we don't get into the realms of forecasting bond yields in our valuation process, but that said, I think that bond yields clearly have risen. The spread remains very attractive, and actually I think it's really important just to note the spread versus real bond yields. Index-linked bond yields are still close to historic lows, and we always talk about the nominal bond yield as being the risk-free rate. I mean, actually, a better risk-free rate is perhaps that index-linked bond yield. So the spreads there are even wider, and of course, real estate, part of real assets, as I've said, pro-inflationary, pro-cyclically. So those spreads are really, really attractive. And I say, so we don't make any explicit forecasts of bond yields, but it's not surprising to me that bond yields have risen in response to what has been a remarkable restarting of the economy post a remarkable, extraordinary economic crunch caused by the coronavirus. So, look, I don't know where bond yields will get to, but when I look at where the US 10-year is, when I look at where the German 10-year is, Spanish 10-year, UK 10-year, those look like fairly understandable adjustments to take account of this phenomenal restarting, reopening that we've had. And I think that even if bond yields were to move up by another 50, 100 basis points or so, that would still leave real estate and broader real assets looking really attractive. This spread at the moment is extraordinary, not ordinary and not normal. So yeah, bond yields may well keep rising as this restart goes on, and the sort of the risk of further variance dissipates a little bit in terms of coronavirus. But I think that spread will continue to look attractive for a long period to come.
Okay, thanks. Another topic, and you just raised, it's about this price disconnection. When you look at the private markets, we have seen transactions even below 3% yield. When you look at the capital markets, potentially some companies are undervalued when you compare the market evidence of this private transaction. The question would be for both you. So, Paul, do you see an opportunity to invest in a direct way, in an indirect way rather than direct way? And James, do you see some opportunities of consolidation because of these opportunities about valuation in the listed markets? Paul?
Yeah, I'd be very interested in James's view on some of this, but I wouldn't claim to know the listed market nearly as well as him. But when I look at the broad themes in the market, maybe not company by company, but kind of sector or country group by country group, I don't see a massive difference between how the listed world and the private world are viewing things. If you look at the sort of premium or discount to NAV, it's kind of flat. If you took the market, the whole the whole of Europe as a whole. And if you look at the sort of implied cap rates when you take out leverage and development pipelines, which kind of create a bit of noise, again, the yields in taking markets as a whole look fairly similar. I'm pretty sure James will be able to identify lots of companies, individual companies that look better or worse value. But in aggregate, I think the markets are actually speaking a fairly similar or humming a fairly similar tune at the moment. James I'll be very interested in whether he agrees with that comment. Maybe a couple of areas I think where there may be a little bit of difference, as I see it, is maybe German residential, and I think James mentioned that looks attractive in the listed space. A bit of a discount from what I can see in the listed, maybe because of this regulatory concern. And also offices, a bit more of a discount that you see on some of the office plays against what we see in terms of prime yields. But again, we're comparing prime yield for an individual asset maybe against a portfolio that would have a collection of assets and locations. So I don't know whether that helps frame James's section, but I think actually there's quite a lot of resonance between the two markets at the moment.
Yeah, I think a couple of broad comments. I mean, I think on the whole, listed markets do reward ambition and they do reward growth. Growth tends to feed through to the bottom line very rapidly if you are a company in an attractive sector. So you take German residential. I mean, this is quite a sort of homogenous sector. I mean, they're trading in widgets really, essentially. And if you grow, then you can feed that you can do those accretive deals and actually sort of feed straight through to sort of bottom line cash flow growth very, very nicely. There are some companies that are operating in similar sectors, similar markets, that in my view would probably look better if they were actually combined together. You could take out quite a lot of costs. So on the operational side, there would be efficiencies there, but also on the whole, cost of capital tends to reduce if you're a little bit bigger. Now, I'm not a believer in, bigger is better in all cases. Actually, real estate is entrepreneurial. And sometimes when you grow the asset base for a management team, actually you dilute the entrepreneurial ability and actually you reduce the return on equity. So bigger is not always better, but there are certainly some cases where I think actually there would be operational efficiency and actually financial efficiency to be gained if you saw a little bit of consolidation. In terms of where markets are mispriced, yeah, I think some of the residential markets, particularly in Germany, again, there's been such a lot of noise around regulation, and these are very large companies now where generalist investors can get involved and sort of blow things around all over the place. So yes, there's some opportunity there. Again, I'd agree with Paul that some of the office players have been mispriced in public markets. Directionally, however, Paul is absolutely right. Directionally, public markets are valuing the most attractive sectors on sort of higher multiples, lower yields than the least attractive. So again, public markets love logistics. They don't like retail. They're a little bit uncertain about offices because they're not entirely sure still what's happening in terms of office markets as we come out of coronavirus and whether there'll be scarring or structural change and who the winners are and who the losers are.
Okay, let's cover a little bit ESG. Real estate, it's very ambitious about the ESG strategy. We have seen in the bond market, for example, 30% of the ESG bonds being from the real estate sector. Europe leading the ambition on the carbon footprint reduction. So a lot of noise, a lot of leaderships in some certain players on ESG and on the decarbonization of the portfolios from the different companies. At what extent, and we need to be very, I would say, efficient in the answer because we don't have too much time. At what extent do you start to see some green premiums in certain assets vis-a-vis the trapped assets or brown assets? and at what extent also it's important, it's an important driver for you when you take the decisions where to invest in the companies who are leading these strategies, or in the assets that can be, of course, green assets or green assets. So what is the real premium, if you see and you are factoring it, and if there is only an ambition or there is a clear path and a real decisions and a real transformation event from the companies. Paul, please.
Yeah. I think in terms of pricing in the direct market, it's slightly difficult to say at the moment. I'd say if you took, let's try and make it a bit more precise. If you took the office market, there's clear liquidity for good quality prime assets that generally have strong ESG credentials. And there's quite an absence of liquidity, or at least market transparency on pricing for the rest. So I don't think the private market has yet given valuers, let's say, a clear answer to what the pricing difference is. I think it's more evident. You mentioned the debt markets. You're starting to see it in the pricing of bonds. We did one of our funds, a green bond, at the start of the year, and we just did another one yesterday, actually. So, and we think there is a notable premium in there. It's not massive at the moment, but it's probably 5 to 10 basis points, which, when you're talking all-in rates of less than 1%, is a notable difference. I guess in terms of how we're assessing assets, yeah, ESG absolutely critical to us. We're actually very excited by opportunities to improve ESG credentials. We think there's going to be a big wave of renovation opportunities, we will price that as accurately as we can. But I think it's fair to say we're all on a journey at the moment. The regulatory backdrop, the guidance, the frameworks keep moving, so our plans need to be very sort of dynamic. And there's some stuff we can do very quickly to improve, say, carbon reduction, and there's some bits that will take a little longer. I did note your comment to keep brief, so maybe I'll pause there and see if there's more time to go and tell you more of those points in detail.
Thank you, Paul. James, something to add?
I agree with everything Paul has said. Environmental, social, and governance factors absolutely go to risk, and therefore they absolutely go to value. The best management teams tend to do everything well. So the management teams that have really sound balance sheets, really well-run portfolios, they will tend to get the environmental, social, and governance things right to reduce their risk. If you go back to our valuation process that I described a little bit earlier on, we build up a cost of equity, a discount rate for every company, and E and S and G factors are part of that build-up of cost of equity. So we, as one market player in an enormous market, we are pricing companies and therefore buying and selling companies partly on the basis of their environmental, social, and governance risks. Now, if we're doing it, then others will be doing it too. I'm a little biased, and I would say that I think we do it in a slightly more sophisticated manner, and we probably get it a little bit more accurate. But the world is moving this way at pace, and therefore the valuations that people place on companies and on assets are going to increasingly factor in these things, and pricing will move that way, and returns will follow, undoubtedly.
Thank you.
Excellent. Thank you very much. I think that we are coming to the end. I hope that we have achieved our homework successfully. We wanted to know about how investors are reading the market, and as a summary, my takeaways are that you are positive about real estate. There's appetite for real estate. Even more than that, there are more asset classes that are attractive now to invest as it happened 10 years ago. As a KPI, we haven't talked about pandemic. We haven't talked about coronavirus. It's the first time that we mentioned that. That means that we are probably getting away from the past crisis that we've gone through. Not only that, but also we shouldn't be maybe that worried about inflation. It may be, at the end of the day, good news for the real estate sector. I think that, or we believe that this optimism is good to make things happen. And obviously, in this evolution of the sector and of the real estate, ESG is super relevant. It has a real impact in life. As we always say in SADE and ULI, everything that we do, it happens in real estate. We sleep in a house, we work in an office, we go on holidays in a hotel. So this real estate must be sustainable, and this is what is happening. And it's also good news that you are factoring this in the cost of equity, because this will help all the companies and will encourage all of them, the ones that are lagging, to hop on this trend and be there. So thank you very much to participate in this debate, James and Paul. We are privileged, the BNU, Barcelona, the ULI, and the US and the SADE, to have you all here. Carmina and I had a great time preparing this debate, and I hope that all the audience that are behind the screens next year, you can be all here with us, and you too also, instead of being in London, you can come to Barcelona. So thank you very much.
Thank you. It's been a pleasure.
Thank you, everyone.
Muchas gracias a los cuatro. Creo que habéis tratado temas candentes, temas punteros. Entre ellos, algunas de las conclusiones que hemos sacado es que es tener en cuenta que hay que revitalizar el sector inmobiliario, pero teniendo en cuenta también el medio ambiente. Lo comentaban ellos mismos, las características de los edificios son claves. Hay que encontrar un equilibrio entre la oferta y la demanda, y esperan que eso suceda en España. Son algunas de las cuestiones y conclusiones que hemos sacado en este último debate. Muchísimas gracias a Carmina, Montse, por moderarlo. Creo que ha sido muy interesante. Nosotros vamos a seguir en el siguiente panel hablando sobre Tokio. Es una de las ciudades que representa ahora todo un reto en cuanto a la transformación, sobre todo en materia de movilidad. Así que no se vayan, porque seguimos con muchos más debates y muchas más cuestiones. Gracias.